Nilesh Access Direct joins us live now. Nilesh, morning. Good to have you back on ET Now. Nilesh, I understand and I really appreciate your compliance when it comes to an individual stocks. But what do you think Infosys or the management commentary from Infosys Technologies means for the entire IT sector?
One, this is probably for the first time where a leader is saying that their growth will be lower than the industry benchmark. Now the mute question is that will the industry revise its overall guidance? And if that happens, it will be quite negative for the sector. Second, this was a period where rupee depreciation kind of helped the industry to overcome the global difficulty. But now in the guidance we are seeing that currency depreciation has no more weightage, and it's the global uncertainty which is causing worry to the industry. The third thing is that in the whole of 2011, probably globe was under far more pressure than expected in 2012. If we see the recovery in equity markets worldwide, if we see the body language of central bankers around the world, they are all talking about recovery. And here is industry which is giving a guidance which is of a slightly depressed in nature. So clearly there are trends which are going counter against normal intuition. Rupee depreciation should have helped, but that's not reflected. Global recovery should have helped, but that's not reflected. And leader is talking about guidance of growth below the industry standard. That's also not expected. So all these things is going to put huge amount of pressure on the technology sector, and we'll have to wait and see how other large components of technology sector gives the guidance or gives the assurance for the future.
Nilesh, what about the body language of our own central bankers in light from what we see from the saw from the IIP data yesterday? What does it seem like? What is it that the central bank is going to do come next week?
I mean, one, the reliability of IIP data due to continuous revision kind of hampers central bank's ability to take them at face value. Now, notwithstanding the sharp revision, which unfortunately is on the downward side, clearly it gives a pointer to the direction that economy is sleeping on the growth side and it needs support. Now, support can be provided on two sides: one, liquidity, and second, interest rate. RBI has been cutting CRR and pumping liquidity through LAF and other operations into the system. Now they have two options. Either they have to increase liquidity by cutting CRR, and they've already cut CRR by 125 basis points, which through multiplier effect will help in pushing up money supply, or they should cut interest rate. I think it's a touch and go kind of equation. We'll probably know in the morning of 17th whether RBI has decided to cut policy rates to spur growth, or they have decided to provide liquidity through open market operation, through CRR cut, or through other measures in order to spur growth. I think chances of both the things happening are kind of 50-50, evenly balanced. A lot will depend upon the analysis and gut feeling which the governor will have on the 17th. So keep your fingers crossed, hope for the rate cut, but if not, at least liquidity should be there to support growth. Today people will be looking at guidance from other large IT companies before taking a call on the IT sector. But the first reaction will be to trim their holdings on IT sector, because some positions would have been built assuming that IT was a all-weather defensive sector. And that flow should move towards other undervalued sector, probably related to, if they move towards defensive sectors, it could be sectors like pharma, or if they want to move towards other undervalued sector, it could be sectors like banking and financial services. So in some sense, short IT and long other defensives or undervalued sector will be the trend which most portfolio managers would like to continue.
Nilesh, I just want to get back to the point that you were making before the market kick-started trade as to how the street is pretty much split on what the central bank is going to do. What if there is no action on repo as well as reverse repo? How disappointed could the market be at that then?
The market today is hoping for a rate cut. For them, the priority is liquidity and then the interest rates. If liquidity is available in sustainable quality and quantity, then probably people could afford to pay 0.25% extra interest rates. So what will be most critical is the liquidity. Since May 2010, Indian economy has kind of suffered a very, very tight liquidity cycle, and at some point of time that's putting brake on our growth. So if you can provide liquidity, markets will withstand a 0.25% not rate cut in the interest rates and still hope that growth will continue its momentum. So more importantly, it is the liquidity measures which will be derailing the market. Today the fear for the market is large government borrowing program. Last year similar size of borrowing program went through by active support from RBI's open market operation. Last year they started in November 2010. Now, can this November 2011? Now, can they start a little earlier this time? I think market will be far more focused on that than interest rates alone.
But Nilesh, do you think Infosys guidance is also some kind of an indication that globally, yes, of late US economic data has been strong, European economic data has been strong, but the real global recovery is yet to start?
I just want to highlight one piece of statistics which I learned yesterday. Over the last 12 years, the American stock markets are virtually flat. In spite of that, they have paid $2 trillion worth of dividend. So almost 150% of India's market cap has been distributed by way of dividend in just last 10-12 years. This kind of shows the strength of the corporate America. They are sitting on cash and they are capable of spending money which will enhance their productivity. So while the guidance right now has been fairly muted, probably we also need to remember that Infosys always believes in under-promising and over-delivering. So there will be a small element of surprise notwithstanding the current disappointment in terms of actual delivery. The second thing is that probably global uncertainty right now is more in terms of sentiment rather than in terms of actual reality. The corporate US balance sheet is fairly strong, and at some point of time they will open up their doors towards enhancement and productivity through IT. So my feeling is that after a base is set based on the current muted guidance, there will be some recovery if the actual trend of under-promising and over-delivery continues in Infosys.
So you would bet on a second half surprise or a second half recovery from Infosys?
Potentially, yes.
What about FMCG stocks and other consumer stocks? Do you think globally and locally a lot of fear trade is driving the HULs, the ITC, the Britannias and the Nestle? And some of these stocks now, if not a bubble territory, they've reached mature territory for sure.
Definitely. One, there is no alternative over here. If you want to hide from the volatility, the only sector which gives you that assurance is FMCG. If you want to hide away from the potential equity raising and dilution, the only sector that's available is FMCG. So where there is no fear of dilution, there is no fear of supply, and there is no fear of uncertainty on growth and profitability, FMCG sector by default over the last many years have occupied that space, and in turn, if they are trading at 30 times and 40 times, every 1 rupee increase in their profitability continues to increase their market cap by 30 or 40 times. So it's kind of becoming a self-sustaining thing where there is no supply, there are no sellers, profitability is going at a reasonable pace, they look like oases among the desert, and this whole trend of FMCG continuing to trade, which we may call a matured valuation, but in other terms could be considered expensive valuation, is likely to sustain.
So for next 6 months, should investors bet on risk on or risk off?
I think we are at a stage where markets are fairly valued. It has lots of negatives, but that's all priced in. It has some sort of positives, and that's also priced in. The future of market will depend upon how variables shape up. If there is a correction in oil prices like it has happened in natural gas, then suddenly Indian markets could take off. If RBI kind of cuts interest rate cycle and that helps in spurring capital growth, capital investment, and growth kind of comes back, then suddenly the whole scenario can change. But that's not going to happen in a hurry. So we are going to see a range-bound market, and where investors, if they can accumulate stocks rather than just top-down sectors, I think there are lots of stocks which are available at a very, very attractive valuation. They're available at below 5 times, below 6 times. These are all good managements generating free cash flow, and they have a track record of great performance. This is probably one of the best times to accumulate your portfolio, accumulate your stocks. Don't worry about the short-term volatility. Markets will keep on going up and down. Prices will keep on fluctuating. But if you accumulate in a falling market at a cheaper valuation, I think over a period of time you'll make a great return over here.
Nilesh, from a global perspective though, does it seem like news flow out of the Eurozone still poses the biggest risk?
I think there we are probably going to see a cycle like a Mumbai monsoon. Sometimes it will rain, sometimes it will not rain. We have seen a huge amount of liquidity provided by ECB. Now, there is very few academic research done. If central bank provides the lender of the last resort and pumps in so much liquidity, what happens? I mean, one thing, if I have to visualize today, 3 years down the line when there is $1 trillion worth of euro going to get withdrawn from the banking sector, assuming LTRO comes to its logical end, what will happen to Europe? Will Europe be able to pay $1 trillion euro back? I think the answer is no. So we are probably going to see fair amount of volatility in the news flow of Europe. Right now probably things are reasonably balanced. Their IIP number equivalent came at a positive number. Street was expecting 0.2, it came at 0.5. The scare on the Spain and Portugal and Italy is also coming under control. There is an election in France in the month of probably next couple of months. Hopefully that should also result into not populist policies but more of a sound economic policies. Putting all these things together, on a seasonal basis we will continue to hear good and bad news from Europe. It's not going to be wished away very quickly. The fundamental corrective actions which is required to be taken is not being taken. They have kind of put everything under the carpet by providing huge amount of liquidity through LTRO. At some point of time they'll have to start taking corrective action. So Europe will continue to give small pinches of volatility to the Indian market.
Nilesh, do you worry about the overall course Q4 earnings could take? Because if I look at the Bloomberg consensus for the Sensex and for Nifty companies, by and large the consensus is that Q4 earnings, they could disappoint us.
If you see Q4 earnings under our universe of about 131 companies, we are looking at a growth of about 10% if we remove one-off items like SBI, which last quarter reported a huge amount of correction in its profitability. Coal India will also have one-off item in terms of wage revision. So if we remove the one-off items, we are looking at about 10% year-on-year growth in the earnings. Now 10% looks a reasonably muted number, but if we look at the last 3 quarters, which has come at about 9%, 8% and 12%, then 10% doesn't look that bad. Second thing, what will be critical is going forward what will happen. Last whole year we had seen tight liquidity, kind of elevated interest rates, high inflation, strong depreciation of currency, and probably much higher oil prices vis-a-vis last year. Now for the next year we are probably going to see interest rates which should be stable to declining, liquidity which should remain from kind of extreme negative to little bit negative and maybe at sometimes positive. We will see currency remaining stable or volatile in a very, very narrow range. We will see oil prices probably coming down rather than going up like last year, and inflation remaining little less than elevated. So there is a conducive environment for earnings growth to come next year compared to last year, and hence that should support the market. More importantly, market today is trading where it was trading first time in 2007. For 5 years markets have remained flat, but earnings have certainly grown up by 30 to 40%, and hopefully next year it will grow up by another 10 to 15%, and that will keep valuations attractive, cheaper, and that should be reflected into prices at some point of time. So yes, Q4 earnings are not going to be extraordinary, but the potential for future earnings growth in FY13 looks far brighter than FY12.
Nilesh, my friend, you've convinced me today that there is light at the end of the tunnel for Indian equities. And when I started the show, I was a bit shaky because Infosys guidance was poor. But after this conversation, I'm sure I'm a believer that there is light in the end of the tunnel. Final question where I'm sure you will have a bearish stance, which is PSU stocks. Given the way how government policy has moved for Coal India, for IGL, for ONGC, do you think PSU stocks in the next 3 years, they will destroy wealth?
If we see the history of PSU stocks, the one of the sector which has received, in terms of from an investor point of view, stepmotherly treatment is the oil stocks. There has been an inordinate amount of subsidy burden on them. And if we see the long-term average performance of oil stock, it's not scary. They have still created value for shareholders. For a long period of time, they were market outperformers. And if I take a longer period of time, they are still market outperformers. So in some sense, PSU stocks are doing a dual responsibility of serving the nation as well as the shareholders. And there are periods and occasions when shareholders' interest has taken a backseat versus serving the nation. The second thing which we have to remember is that a lot of these PSUs have received certain favors and advantages from the government in terms of resources allocation, in terms of favorable treatment of trade, which a private sector counterparty does not have. And probably if we do the fair pricing of that, it's going to be reducing the impact of subsidies which government is putting on those counters. So my request to investors will be, PSU sector is not something which can be ignored completely. Yes, it sometimes gets stepmotherly treatment from a shareholder point of view, but if we see over a period of time, PSU stocks have created value, and the best time to buy PSU stocks will be when there are all kinds of negative headlines sitting about them, and the best time to sell them will be when there are all kinds of positive headlines sitting about them. So if you have a PSU stocks in the portfolio, probably this is not the time to sell because a lot of negative news are appearing about them. Maybe this is the time to accumulate. Soon you will see a scenario where positive news starts coming about them, and that's the time when you can trim.
Okay, Nilesh, so good to have you on the show and chatting with you today on the market as well as the macro.